Very good morning to everyone. My name is Joel, and thank you for joining me at FSMOne Expo today. As the MT has mentioned, I'm a research analyst with iFAST. Tech stocks delivered impressive returns last year, and the tech sector, as measured by the Nasdaq Internet Total Return Index, delivered total returns of 30% last year, outpacing the S&P 500 already very strong gain of 25%. With such a substantial rally in the tech sector last year, the big question is, should investors prepare for a potential pullback? Or is there more room for this bull market to continue? And with AI being one of the hottest topics in recent times, the key question remains, does AI truly drive profitability for companies? Or is it all just hype? Today we'll explore these questions and dive deeper into what the future holds for the tech sector. In the first half of 2024, gains in the US stock market were primarily driven by the tech sector. The equal weight S&P 500 index delivered only a third of the returns of the market cap weighted S&P 500 index, which is heavily influenced by your tech giants such as NVIDIA, Apple, and Microsoft. In the second half of the year, however, the market rally expanded beyond the tech sector, with both indices delivering comparable gains. Looking ahead, with the US economy remaining resilient, the Fed cutting rates, and earnings growth improving in non-tech sectors, we can expect this broadening trend to persist. That said, we still expect the tech sector to continue leading markets. Tech stocks are generally classified under the information technology sectors, as well as the communication service sectors, and the earnings growth of these two sectors is projected to outpace that of others. As share prices are fundamentally driven by earnings, the promising earnings outlook of the tech sector suggests that it should continue to outperform over the medium to long term. And what is driving this strong earnings growth in the tech sector? Well, you guessed it, AI. The truth is, AI is nothing new. In fact, it has been around for decades. However, the launch of ChatGPT in 2022 brought AI into the mainstream, and the surge in public interest sparked an explosion of investment and innovation in the field. Your big tech companies like Amazon, Google, and Microsoft are experiencing significant growth in their cloud revenue due to the increasing demand for AI solutions. Given the capital-intensive nature of AI development, many companies are relying on big tech's cloud infrastructure and AI tools to train their own large language models and to integrate AI capabilities into their own model products and services. For example, Amazon's Bedrock or Google's Vertex AI provide developers with powerful tools to build, to customize, and to deploy AI applications that are tailored to their specific business needs. In addition to enabling enterprises to build their own AI capabilities, Big Tech has enhanced their existing core offerings with AI features. Take, for instance, Microsoft has integrated AI features into its Microsoft 365 Productivity Suite through Copilot. And this has enabled users to boost their workflow with AI-driven tools that are available for an additional subscription fee. These factors have driven strong double-digit growth for the cloud segments of Alphabet, Amazon, and Microsoft. Unlike the many unprofitable dot-com stocks in the late 1990s and early 2000s, if you recall that period, those companies were valued based on metrics like eyeballs and page clicks. However, the current AI boom is led by highly profitable big tech companies that have demonstrated their ability to monetize AI. Microsoft, for instance, Microsoft's AI business is on track to exceed $10 billion in annual revenue by the next quarter. And while Amazon and Alphabet did not provide exact numbers for their AI revenue, their management did highlight that their AI businesses have generated billions in revenue. For Meta, the path to monetizing is not as clear, as AI's primary role for Meta is currently to increase engagement on its social platforms and to improve conversions for advertisers. Although this will likely lead to higher advertising revenue, direct AI revenue in the billions will likely take more time to materialize. And this is also partly because Meta has historically had a preference for prioritizing user growth before monetizing their new products at scale. In Big Tech's third quarter earnings call, executives were unanimous in expressing the need for greater spending on AI, as they see demand remaining stronger than current available supply. capex of big tech has risen in recent years, and we expect that to continue as they remain constrained by the existing AI infrastructure, particularly in GPU capacity. And while AI revenues currently lack capex, we expect that gap to narrow as AI adoption continues to pick up and companies realize the immense benefits of incorporating AI into their operations. Looking at the chart on the right, we see that capex as a percentage of sales remains at healthy level. And with the exception of Microsoft, big tech's capex to sales ratio is projected to stay below historical peaks. So to help you better understand this whole hype behind AI and why companies are so willing to splurge on AI spending, allow me to illustrate the tangible benefits that AI brings with some real-life examples of generative AI, or Gen AI for short. Gen AI, for those who are not aware, is a form of AI capable of creating images, text, videos, and audio based on input prompts, just like what 𝗪𝘃𝗀𝗁 showed earlier. And I guess the most familiar example of Gen AI would be ChatGPT. So at Alphabet, right now over 25% of all new code is now generated by AI. And all the engineers have to do is to review and refine the outputs of AI. And so this internal use of AI to improve coding processes is boosting productivity and efficiency for Google. Alphabet is also empowering other companies to harness the power of AI through its AI tools. So for instance, Warner Bros. Discovery built an AI captioning tool with Google Cloud's Vertex AI that can automatically generate a time-coded and formatted caption file for videos. And this has helped to streamline what was once a time-consuming and very manual process. So with human input now limited to just verifying the accuracy of the caption as well as the synchronization of that caption, Warner Bros. Discovery achieved a 50% reduction in overall costs, and they also cut the time by captioning by 80%. Moving on to AI agents, so building on the capabilities of Gen AI, we are also seeing a shift towards more sophisticated AI agents that can handle complex tasks on their own. So these digital assistants don't just respond to user prompts based on predefined logic. They are in fact capable of making decisions and solving problems in dynamic environments. So just to give you a few examples of AI agents, one of them is Air India's AI.G. So this was developed using Microsoft Azure's OpenAI service. And this virtual assistant currently handles 97% of customer queries completely autonomously. And this has helped to save the airline millions in customer support costs while enhancing the customer experience. Similarly, Germany's largest health insurance company, 𝗪𝘃𝗲𝗀𝘁, apology for my pronunciation, used Google's AI solutions to cut claim processing time from around 25 minutes to just 3 seconds today. And this has greatly boosted efficiency. So these examples have demonstrated how AI is empowering employees to automate repetitive, mundane tasks, and instead has allowed employees to focus on higher value strategic work. So in the long run, this will not only help to drive cost savings, but also boost revenues for companies. So given this broad utility of AI across industries and the immense benefits that it brings in terms of productivity gains, we do not think that companies' strong demand for AI solutions, nor big tech's high capex spending, is unwarranted. Throughout history, if you look at this graphic, we can see that the transformative potential of new technologies have often been underestimated. Morgan Stanley reports that initial estimates for personal computers, for your mobile phones, your internet, as well as cloud computing markets, they have historically fell short of estimates by an average of 38%. And with Google CEO Sundar Pichai claiming that AI is more profound than fire or even electricity, it's possible that we are again underestimating the AI's true potential. There are plenty of investment opportunities in the tech sector. However, we continue to favor big tech for a number of reasons. So firstly, big tech companies are leading the charge in AI development. They not only develop cutting-edge AI technologies themselves, but they also back independent model makers such as OpenAI, which owns ChatGPT, Mistral, as well as Anthropic, and they do this through funding and partnerships. As such, big tech is expected to be key beneficiaries of AI growth. Secondly, secondly, US tech giants have global business models and they have strong competitive advantages. These companies operate on a global scale and they have consistently been able to grow their revenue by capturing market share in international markets. Today, Amazon, Microsoft, and Alphabet hold over 65% of global cloud market share, while the same few companies, Alphabet, Meta, and Amazon, collectively account for more than 60% of digital advertising spending. So in addition to that, they have several key competitive advantages such as your network effects and high switching costs. And these advantages have made their products and services integral to the daily operations of consumers and businesses. And this has enabled them to sustain their growth and profitability over time. For many people, it will be difficult to imagine a world today without Google search engine, Microsoft Office, or social media platforms like Facebook, Instagram, or even WhatsApp. And the third reason why we favor big tech is because of their strong balance sheets. Big tech firms have huge cash reserves that allow them to invest significantly in R&D. And it also allows them to acquire or invest in promising up-and companies. And this helps to cement their dominant position. In addition, they also have very manageable debt levels, and their high credit standing allow them to borrow at lower costs compared to smaller companies. Big tech are also well capitalized to thrive in an elevated interest rate environment by investing their cash reserves into shorter term debt instruments, and this will help to build up their cash pile even further. So with these solid balance sheets, we believe that these companies are well positioned to navigate a higher for longer interest rate environment while cementing their market dominance. So given this run-up in tech stocks last year, it is easy to assume that valuations today are overstretched. However, the gains in the tech sector are underpinned by robust earnings growth. So using a fair PE ratio, a price to earnings ratio of 30 times, we project a target price of approximately 1,900 points for the Nasdaq Internet Total Return Index by 2026, and this translates to an upside potential of about 29% from the closing price on 16 January. So to sum up my sharing, we believe that the tech sector will continue to outperform even as earnings growth in other sectors improve. We think that AI has immense potential in the long run, and that big tech is well positioned to capitalize on these opportunities. And lastly, despite the strong rally in 2024, valuations in the tech sector are still looking attractive. With that, I'll conclude my sharing, and I hope that you've gained some valuable insights. Thank you, and have a great day, everyone.